Today's episode is sponsored by Tegas. Understanding expert insights is table stakes for investors, and there's no better option than Tegas. I've been using them for almost 2 years to get up to speed on companies, and they've helped me immensely as an investor. Tegas also recently acquired BAM SEC, which adds a super fast way to access SEC filings and earnings calls and to incorporate financial data into my models. I run a monthly deep dive series sponsored by Tegas on the blogs. I'll include a link to my cable deep dive in the show notes, and I'd encourage you to follow the link if you're interested in how expert interviews can help you learn more about a company. Currently, anyone who signs up for Tegas gets free access to BAM SEC as well, so check it out. All right, hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have my friend, Bill Chen. Bill, how's it going?
Great, doing fantastic. Thank you for having me on.
Hey, thanks for coming back on. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. Please do your own work, consult a financial advisor, all that stuff. And then second, with the pitch for you, my guest, this is your second time on. I've told everyone you're the best croquet player I know, but I'm just really excited to have you back on. I know you do great work in real estate. If I was ever going to invest in New York real estate, there's one man who I'd pitch, and it's you. And actually, I was telling you before the podcast, I normally get a good feel for what's really going to resonate with guests. And that's normally like, hey, this is a YOLO stock. It might be up 5X next week, or it might be a zero. And your last pitch, FRPH, which is great. I'll link to it in the show notes. You did not say any of that, right? You were just like, look, I think this is going to generate really attractive risk-adjusted returns over time. And I like that story, but a lot of times I feel like some guests might not. And I was just surprised how many guests reached out and were like, you've got to have Bill back on. I love that pitch. So I just think it speaks to how well, what great work you do and how well you pitch the story. So all that out the way, let's turn to the company we're going to talk about today. The stock is Clipper Real Estate. The ticker is CLPR. I'll just turn it over to you. What is Clipper?
Yeah, so Clipper is a New York-centric, mostly multifamily. They own 3.2 million square foot of mostly multifamily. There's two office buildings in downtown Brooklyn, but it's most of it is multifamily that's spread in Manhattan and Brooklyn. In kind of very simple terms, I think this is a $2 billion company. If we ran an auction and we invite all the brokers and all participants to bid on these assets, I think this collection of assets will sell for about $2 billion, and you could buy it for about $1.4 billion today. And that's about $1 billion of debt and about $380 million market cap. They did some transactions. I think the cash balance have moved around a little bit. The debt's a little bit more than net debt's a little more than $1 billion, but I think 1.4 billion EV today is. So you're buying it at 70 cents on the dollar for a collection of New York City assets, which is mostly multifamily. And what's really exciting is that you're getting a little bit over 4% dividend yield today. And I think that, by my estimate, I think they could actually, over time, the next 3 years, they could potentially increase that dividend yield to about 7% on today's price. So you're getting paid to wait. You get to collect a 4% dividend yield while you wait for the I believe market is probably about 20 to 25% above what the existing rents are currently, but it may take show up in the financials because you can't just reset that to market. You want to keep a certain number of your existing tenants in the beds, and you can't push that all the way to market right away. But this is a great setup because you're buying in at this collection of assets at about 4.6% cap rate, and then when it's all fully stabilized, you look out 2 years, you're looking at closer to 6% cap rate for New York City multifamily, which is kind of a really deep bargain, and you get paid to wait.
Paid to wait. Well, Hey, that's perfect. A lot of stuff I want to dive in there, but let me start with the question I'm kind of trying to start the podcast with. We're investing in this, you're investing in this because you think it will generate a attractive risk-adjusted return, right? And to do that, you have to be right about something that the market is wrong on. So what is it that you see that you think the market is missing here?
So I think there's an element of kind of like what I traffic in, which tend to be small cap real estate. There's some sort of investor fatigue. There's some sort of trading illiquidity, right? Like, this is not the most liquid. I think there's been a couple Seeking Alpha articles recently that actually bump up the trading liquidity, and trading liquidity is about $1 million. Even though it's a $2 billion company, where the equity should be worth $1 billion, the daily trading liquidity is maybe $1 billion, right? So that creates some issues. And I think that there's some stigma attached to the name because it IPO'd at $13 in 2017. There's been multiple write-ups on Value Investor Club, and the stock has not worked in the past, right? The stock has not worked, and there's some history there, right? Because when they IPO, the company was really, really subscale. They raised the IPO, raised some equity, went out, bought a couple of deals, and my family is in the New York City real estate business, and we know if you try to go out and buy some deals in 2017, 2018, that was a really, really tough time to do deals, to try to do value add deals. None of the deals could kind of really pencil out just simply because cap rates were low. Every deal was being marketed. There was no deal that you were paying super low cap rates. There just really weren't any good deals to have, and they IPO, they came public, they were subscale, and then 2019 you have the New York City rent regulation laws. That kind of put a damper on. So like it's been many years. It's trading at roughly $9. It IPO at 13. So there's been a lot of unhappy shareholders, but since then, what has happened is that they've grown into the companies that they acquire. They've been able to do the value add, bring on those net operating income, bring on those cash flow, and of course the biggest event was COVID, right? Like everything was supposed to work. It was like 2017 the IPO, we're going to do a bunch of deals. Like deals were tough, and then finally early 2020 was when they stabilized the building. They were all these numbers were going to show up nicely, and then we have COVID, right? And through big monkey wrench. And I think the opportunity exists today because you have this history of disappointment and kind of a little bit out of their own control dynamics that we're finally kind of starting to see. Okay, now they've actually got $65 million NOI, which I believe that could go to 80, like almost 80, and then when they stabilize two of the development projects, to get to into the high 80s, right? And I think when everything stabilizes, this could trade to somewhere in that kind of 9 to 12 times price to AFFO, which is really, really cheap for a multifamily REIT.
Perfect. And I think there's again, a couple things we should go through, but I guess the elephant in the room right now is the COVID recovery, right?
Yes.
If you and I, and I know this because I told you before the pod, I think I put in the Twitter notes, I just got my rent renewal. A year ago, if you were getting rent renewals, it was a renter's dream, right? They were concessions left and right. And right now, as somebody with a rent renewal, I can tell you there are no concessions coming. So let's talk about the near-term environment, because I think if we can also talk valuation there, but when I just look at it, I say, okay, AFFO, I think was like 16 million or something for 2021. Yes. This is a almost 400 million market cap stock. We'll talk about leverage in a second, but when you look at that, you say, oh, that's not that cheap, but obviously that's trailing numbers, which includes, a lot of those covered. So what does the environment look like going forward? And how should we be thinking about kind of the near-term environment starting to flow through the financials?
Sure. So they have on their earnings calls, they've been consistently saying, okay, as of this day, as of February, they're if you look at the supplementals, you look at what the existing rent is at each building, right? So Tribeca House is a building that they own. I believe the number is $62 a square foot, but they're signing leases at $83 a square foot, right? That's what new leases. You probably can't get 83 if a tenant is in there and they're looking to renewal, because you want to raise the rent, but you probably can't do that lease at 83, right? But you could probably get 75. You could push through. You still push through. I think that any new lease, whether it's a renewal or new lease, gets done at least 10% above what it is currently, right? And that's what's really exciting at the moment right now is that you have all this trailing 12-month leases that were COVID. I think it started to change in kind of Q3, Q4, but a lot of those are still from and COVID leases tend to be a little bit longer, right? Um, because people do want to lock in those COVID leases, those specials. So you got a dynamic where we're at 65 million of NOI. I think that if we're talking 12 to 24 months from now, that run rate number could be 77 to 80 million dollars. And this doesn't even include any new, the new developments that they have, right? So it's just, to me, it's a 1 foot hurdle, right? It's a 1 foot hurdle because the way to look at it is that the $1 billion of debt, the interest expense is about $40 million, about $10 million G&A. At 65 million, that gets you to about 15, 16 million of AFFO, right? Now, if you go from 65 million to 77 to 80 million, now all of a sudden that AFFO is $30 million, right? And then you stabilize the two new development projects. There's one that's supposed to be finished at the end of this year. That's going to probably add another $5 or $6 million of NOI, right? Now all of a sudden you're in that mid 80s, like kind of low to mid 80s NOI, and your fixed cost is still kind of probably like somewhere between 50, 55 million. Now we're trading at a really low multiple to AFFO, and they'll probably raise the dividend rate.
Perfect. So I mean, I think the story is, and this is, every investor loves this, right? You've got something that's highly leveraged, both financially and operationally, right? Every dollar increase in rent should flow pretty much straight through to the bottom line. So you get something with a lot of leverage. They're raising rents. It should flow straight through to the bottom line. AFFO goes from 15 to 30 to 40 million real quick. And all of a sudden you're looking and saying, hey, I'm buying New York City apartment buildings for less than 10 times forward free cash flow, 12 months out or something. Where else can I get that deal?
Yeah. And I just want to kind of, comment on the leverage, right?
That was my next question. Yeah,
sure.
Go ahead.
Yeah. And I think it's really important. I think what makes Clipper unique is that they, these are old school Brooklyn guys. The management team, these are people who they've been in this line of business for a really, really long time, right? So they don't necessarily operate in a standard REIT environment. They kind of operate like how my family would run a business, right? And if you think about implicitly, if you buy a 4% cap rate multifamily and you're going to do 50% loan to value, that naturally implies that you've got to put about 12 times NOI of debt on it, right? So when you think about it, you're like, oh, like that's a lot of leverage, right? Like the EBITDA is over 10 times. Like you think that's a lot of leverage, but in reality, in a multifamily asset where the cap rate is 4%, which naturally implies 25 times NOI, like to put 12 times NOI on it is actually fairly reasonable. And I was, like some of the private guys will put 75% loan to value, right? To go out and get 75% loan to value in the multifamily space in New York City is actually fairly normal. So if anything, they're kind of more conservative. But it just doesn't gel with like traditional REIT metric, which is around 6 times EBITDA. And that's some of the pushback that I get on the name, right? Is that this thing just looks way over levered, right?
And I just want to add, and you can correct me if I'm wrong here, but look, it's about a 400 million market cap company, a little over $1 billion of net debt. And most people look at that and say, oh, that's pretty levered. And again, as you said, not that levered for New York City real estate. But I guess the other thing, and correct me if I'm wrong, all of the debt is held at the real estate level, right? So none of it's held at the holdco level. So even if one building burned down in a fire and for some reason they didn't get insurance proceeds, they would just hand the keys to the lender. So it's actually a lot, I don't want to say it's a lot safer, but it's better than, you look at a high yield company, 6x levered, one business goes down, the whole thing goes down. In this case, there's still going to be holdco value. Am I thinking
No,
about
I mean
that correctly?
that's exactly right, and that's exactly what a savvy kind of private landlord will do, right? Everything, everything is an LLC, right? Everything is non-recourse. Everything is a silo. So the way you think about the debt is that there's each individual building is a silo, and there's a
Yep.
certain liability, that's attributable to that building. And if something goes wrong, you could always kind of like what Blackstone or Brookfield would do, right? Blackstone famously gave back that office building on Broadway. You could just say, hey, this specific building doesn't work for me anymore. Like, the bank, the bank, take this building back, right? Now you don't want to do that too often, because then like but it's like when push comes to shove, right? Like, we're here talking if somehow we get into the great financial crisis, which I lived through, and I witnessed a lot of, a lot of failures in the real estate world. You in a world in a situation like that, you could you could selectively default on these mortgages.
And look, these are 100 million plus buildings, right? Like literally
Yes.
almost all of them have 100 million plus mortgages on them. So
Yeah.
these are huge buildings. Like the lenders here are big boys who understand these are,
Yeah.
my recourse is here. They understand that there is the risk. They're taking that on.
Mhm.
Let me ask you the same question
Yeah.
to ask during the FRPH podcast, right?
Yeah.
So Clipper, cheap stock, great momentum through the rental environment we just talked about, but opportunity cost, right?
Yeah.
First thing that pops in my head when you and I were talking about Clipper is I said, oh, okay, that's great, nice management team, not buying back shares, trades cheaply. Why would I invest in Clipper versus, I just always throw this one out there, so
Yeah.
SLG,
Yeah.
right? SLG probably trades 70-60% of NAV, probably trades a little cheaper than this on a forward yield. They buy back shares pretty aggressively. Like, why is this the play instead of SLG?
Sure. I mean, look, I've looked at SLG. I've been following it. I own a little bit of office during COVID. I think structurally in the long run, so COVID's been a really unique experience, right? Like this goes back to betting on things that will be relevant 20, 30 years from now, right?
Yep.
And like if we were talking a year ago, right? Like, in even in early 2020, everyone's like, no one's gonna live in New York City. It's a debt town. Like, you can't give away the apartments, right? And now you have bidding wars over apartments. And like, like, why is that? I think it has to do with the fact that the density here, the cultural relevance, right? The restaurants, the museums, the art scene, right? There's even tech employees from San Francisco who's moving here to New York because they can work anywhere now, right? And I think that, but the funny thing is, people want to be in New York. They're young, they're hungry, they're educated, talented. They want to be in New York, but they don't necessarily want to be in an office.
Yep.
And I think it's been over 2 years now, and we learn how to work outside of the office. So what's very clear to me today is that if you're single between the age of 22 and 45, right? You want to tap into the the dense dating pool that's here, right? There's something about New York City that keeps people coming, right? And I kind of jokingly say that rodents, roaches, and dreamers with a suitcase are like the three things you can't get rid of in New York City, right? Like people just want to be here, but like people don't necessarily. There's a lot of mixed views over. Do people want to be in the office? Do people want the if you look at the occupancy rates of Clipper's portfolio, it's in the high 90s. If you look at occupancy for office and how that's gonna grow when the leases come off, I don't have clarity on the terminal value of the in-state, right? And you can make the argument, well, that may impact, right? That may impact the the residential side as well. But I have a lot stronger opinion that people still want to be here. Like you literally had a disease, which 15 months ago, we don't know how well the vaccine is going to work. We don't know like is it permanently impaired? But the young folks just want to be here, and I've seen this 3 times. I've seen this after September 11th. I've seen this after financial crisis, and I've seen it under COVID. Like every 10 years, you get an opportunity to buy residential in New York City on the cheap. And every time everyone's like, this is it, it's over. Like, no one wants to be in New York City anymore. But the city just keeps proving people wrong.
Look, you and I both live in New York City, so yeah, maybe we're expressing a biased view. I definitely agree with you, though. We're talking May the 4th be with you. We're talking on May 4th. We're right after tax day. And I think two of the pushbacks I would get would be number one, New York City is extremely high tax jurisdiction, right? Yeah. And with work from home proliferating and everything, like, yeah, right now we're starting the roaring 20s, but in a year or two, when people really start thinking about that tax bill, our demographics against New York City, right? The subway sucks, the taxes suck. Florida's looking pretty nice during the dead of winter. So, what do you think about that demographic pushback?
So I think there's and we could get into the nitty gritty a little bit, right? Like if you look at New York City, it's a roughly 8 million population, right? And you start looking into like I think the narrative feels like, all right, everyone's moving to Texas, everyone's moving to Miami because it's low taxes. The reality is that not everyone is a married person, right, with 2 kids, and they've established their careers already, and they build up the network, and they just kind of stay in touch with people telephonically, right? And not everyone, like there's still a large amount of population that are single, looking to date, looking to advance their careers. They're physically looking to. My take is someone who's 22 to 45 is one, makes a lot less in income, so the tax consideration is a lot less, and also the way that they weigh, okay, my dating life, like do I stress my dating life over how much I pay taxes? And from my experience, being a landlord in New York City with my family for 20 years, I could tell you without a doubt that people value the dating life, the networking, the meeting, going to the cool places, the restaurants, the art events, the random kind of like Brooklyn meetups and whatnot. That I think that's gonna have a lot more appeal, right? And there will be a time. I think especially for someone like me, I moved away from the very center part of New York City and Brooklyn, but I'm kind of aged out, right? I think if COVID showed us anything, is that you could have a pandemic that's happening in real time, and if rent dropped enough, there will be a horde of young single people who says, I've never had an opportunity, it was never affordable, I want to be in the city right now. And I think if anything, that probably made me even more bullish on the city.
Yeah. No, look, I agree. And I would just say, as somebody who is not quite as young and certainly not single anymore, my wife and I said we got our rent renewal, and we talked about moving elsewhere. And, when we put it to shove, we were like, well, at this point, I guess this is personal, but all of our friends are here. Anywhere we'd move, we'd have a lot less kind of activities and stuff to do. And, once you put roots down somewhere, it's tough to move. And there's nowhere for, kind of young, educated professionals. There's nowhere like New York City in terms of most of your friends are probably going to come through here or be around here. Yeah, there's just nothing like it. Let me ask you another bear case.
Let me go ahead. Go into that a little bit. I think I kind of want to do a breakdown of New York City as well, like the 8 million population. So like Brooklyn, Pete David and his crew, right? That's a whole different segment, right? That's like native. That's not going to change. They're going to stay, right?
And they have apartments in Brooklyn and mainly FiDi area of Manhattan, right? Those are the two areas
in the Tribeca area,
and they've got the one Upper East now that I think about it as well.
Central Park West, Upper East Side, right?
So basically all over Manhattan.
Yeah, over Manhattan and Brooklyn, right? It's really Manhattan and Brooklyn. So there's I think something like 3 million people. There's like 1 million household. If I remember correctly, 1 million households are in some sort of rent-regulated rent control, right? And if you are already in a rent-regulated apartment, you don't move, because the moment that you give that up, that's a quasi form of ownership, right? So let's start with 8 million population. There's a certain population, Staten Island. That's probably, I don't even know the population there. Maybe a 500,000. That's just like that's in its own ecosystem. That doesn't like factor into the Manhattan and Brooklyn, right? And then you got something like 2 to 3 million that are in that rent control, rent regulated, like 1 million units, if I remember correctly, right? That they don't move, right? Like they're not like the people like I think we, because we work in finance, we think we could go anywhere, we have the financial means to go anywhere, right? But there's
You say we have the financial means, but it's been a rough couple months, babe. We don't have the financial means anymore, Bill.
But you get what I'm saying. Like I think people in our row have the most flexibility, the most financial means to be able to go settle anywhere, right? You even go to Puerto Rico in a true like zero tax haven. And I think, and then you go out to Queens, right? You go into the neighborhoods, like you go to Corona, that's a predominantly Mexican and Ecuadorian. You go to Jackson Heights, which is, kind of like, there's a lot of Indian, there's all Nepalis, and like there's a lot of immigrants that, regardless of what, like they're not thinking of moving to Texas because this is home, this is roots, right? So when you add up all the population that are in some sort of rent regulated, rent control apartments, and then you add up the immigrant population that don't want to be in Texas because they can't get the grocery, they don't have the community, they may not even speak English, right? And and then you kind of go up to the Bronx, and there's a whole different demographic there. But when you really look at this mobile, highly educated population, there's maybe only 2 or 3 million people out of that 8 million. So the question becomes, are there in any given year, are there 2 to 3 million of like the single, highly educated from some of the top schools? Do they want to live in New York City, right? And I would say that if you segment the population, the cohort, into 22 to 45, single, looking to date, looking to enjoy the amenities, right? I would say yes, unequivocally, that population still want to rent and live in New York City. That's a true mobile, market rate tenant. And I think that 1% of U.S. population want to be here.
It's so silly, but at the depths of the 2020 pandemic, when people were saying New York City is dead, it's so silly. But I would just think there's that Hamilton song where they're singing, we're in the greatest city in the world, singing about New York City. And I was like, yeah, I'm sure they were over exaggerating for the play, but even in the 1770s, that we've got 250 years of example where New York City is the place where if you kind of want to be single and mingle in America, like New York City is the best place to be, or one of the top places to be. And it's like, that just doesn't go away. It's got those, it's the great thing about city. You get that great network effect. And I believe you said in the FRPH thing, the great thing about FRPH's properties, and this very much applies to Clipper's property as well, there's literally a moat around them, right?
Yes,
Manhattan is an island, and there's literally a moat around it.
Well, I mean, that's it. Let's talk about the other thing is that, like, let's talk about rent control. Let's talk about the geography. Let's talk about the NIMBYism, right?
Rent control was going to be my next question, because I've got some friends in real estate, and every time I talk to them about buying an apartment, investing in New York City real estate, the first they say, politics are awful. Everything's going to be rent controlled in 5 years, and you just can't buy anything because everything's going to be rent controlled.
Okay. So this is someone coming from, my family, like we built a little bit of an essay in on the private real estate side in New York City. I've been doing this since 2002, right? Rent control is a hot button issue, right? But what it does is that the combination of having a moat, having this geography, right? Having rent control and forcing any new development to kind of have 30% rent control, rent stabilized apartments, right? What it does is it increase the cost of bringing on new supply. I mean, it already takes about 4 years to bring on new supply, right? And if you look at the stats, something like only 20 units every year gets permitted per 1,000, right? There's more than 20 basis point in population increase. There's more than that kind of increase in demand of people who want to live in New York City, but only 20 basis points for 1,000 people, actually get permitted every single year. What actually gets built is probably less, right? And what rent control does is that these laws, what's interesting is when you look at any industry in any market that's highly regulated, where it's very cumbersome to do business, what it does is naturally creates a barrier to entry for newcomers to come in. It becomes very, very difficult to bring on new supply. And the reason why we know it, because my family's, actually have been doing a couple of development projects. And my younger brother just, he basically calls me up, and it's therapy for him, right? He's like, government wants us to do this, they're not happy with this. And it takes way longer to bring on supply. And I would make the argument that rent regulation makes it, harder to bring on new supply, because now you get 30% of your unit needs to be rent regulated, right? So you can only build, it costs you, the construction cost has gone up, labor has gone more expensive. It's more difficult because now you have fewer parcels of land that are kind of shovel ready, that are easy to build. But now you have to set aside 30% of it to rent regulated unit. So if you own something that's 100% free market, that's in my opinion, that actually becomes worth more down the road. So I think a lot of these regulatory forces, a lot of the regulatory forces, how hostile they are, but it actually forces the market rate to be higher, and to really constrain the supply of the market. And if you talk to people, real estate developers, real estate landlords in Los Angeles, I mean, they'll complain about regulation, but it's also it's also the reason why they're able to push 3 to 5% in rent increases every single year.
Yep. So in the same way, we underbuilt on homes for a decade, and now we're kind of experiencing it with the home price. I mean, New York City, the regulations, bad, good, whatever you think of them, they form a barrier to entry. Supply is going to trail demand, and that just continued price increases for this. And I guess my most bearish friends would say, okay, that all sounds great, but what if they just like pass across the board rental control or rent control for these apartments? That's just not in the cards for this.
No, I mean, I don't think they. I mean, so the 2019 rent regulation, there were a lot of negative regulation that were passed and surprised a lot of industry people. And if anything, there's a court case trying to reveal that.
Yeah.
Really, they're arguing that was essentially taking of property, right, without compensation. So if anything, that's a potential, that's a free option, right, if that gets overturned.
What would happen if that got overturned for Clipper?
I think so I don't know if, I don't think they'll actually get compensation, but I think going forward, make it a lot easier for them to increase rent on the units that are rent regulated in this portfolio. So just so that I think another reason why Clipper is cheap is that out of 3.2 million square foot, there's 1.7 million that are kind of like, if you look it up, you're like, oh, geez, like I don't want to own that. That's rent regulated. It's in Brooklyn. It's not a pretty site. If you look at the reviews, right? Like I'll just go into it. Let's open Kimoto. It's like the tenants complain about rodents and all these things, right? The thing is, and I'll just come out and say it, like the reality is that when you charge people $25 a square foot, which is $3,000 for a 1,000 square foot apartment in New York City. That is that is one of the most affordable product out there in the market. If it's rent regulated, like you're not gonna find happy tenant review. Okay, this is not the Ritz Carlton. Like this is just how life is. And in general, I think most tenant reviews you're gonna find they tend to be negative, right? No one says I love writing a rent check to my landlord. So once you go into that landlord comment, and I get this feedback from people all the time, and they're like, oh, like you read the reviews, it's just awful. You're like, it's different when you go to a market like Vegas, you go to a market like DC, you go to a market where they built these brand new amenitized, multifamilies, and it's almost like living in a hotel, right? Like you may be really happy, but New York City, I mean, I think years ago on Craigslist, I saw an ad of a lady who said she's got a really large bathroom and you could rent her bathroom, as a place to sleep in but like she needs to use it to shower and poop from time to time. And I'm just like only in New York City would you put an ad on Craigslist renting out your unusually large bathroom. Like,
it reminds me of, everyone always hates on cable companies, right? It's
yeah,
like, yeah, of course they hate on cable companies, but if you really thought about, it's because who's ever going to say anything good about a cable company, right? But if you really thought about, like, the one moment your internet goes out, we had a little bit of technical difficulties earlier.
yeah,
You hate your cable company,
yes.
but 99.9% of the time, they're providing you with literally the most important service in your life. You're getting it for $60 a month, and it lets you do everything in your life,
Yes.
unlimited entertainment, everything. It's like, you just don't think about that type of thing. I know it's not apples to apples with the rent, but I definitely understand.
No, I mean there's a ton of similarities between cable and New York City multifamily housing, right? If you think about it, it's someone joked that if you look at the Maslow's hierarchy, right, cable is actually the very most bottom layer, right?
Yep.
Like, there's
cable and rent, right? They're
cable
the
and rent,
absolute
exactly.
necessities.
And if you think about like what are the costs to replicate, right? What is the replacement value? Like think about the overbuilding, trying to dig up trenches in New York City and wire buildings, right? Like it is so difficult. There's so many dynamics that are similar between cable and residential in New York City. And I mean, this is the reason why, like, if you break down the component of why do people get wealthy owning multifamily in New York City, like I have a lot of relatives who were in a Chinese takeout business 20 years ago. And they do not deserve to be super wealthy. Okay, like I'll take that back. Like
they deserve it, Bill.
On paper, they should not be your landlord, right? They should not be Andrew's landlord, yet they are. And the reason is because I think 20 years ago they bought a piece of property. Maybe they paid $250,000 for like a 2-family out in Queens, right? And what happens, is that if you think about the land appreciates in value over time because they're not making any more of it. This isn't like somewhere in Texas where you could just go further out, right?
Yep.
What's been like any parcel that's been built has been built for the most part, right? The structure, right? The structures could last hundreds of years. There's tons of brownstones in New York City that are hundreds of years old, right? So the structure, there's a tremendous amount of value in that. And then really the entitlement and the zoning, right? What's the hardest thing to get done in New York City is that to go down to like the building department and submit your plans and they're like, oh, this is a little bit off, or like your neighbor's complaining, like, it's I've seen it. It takes 4 or 5 years to bring supply to the market, and it's chronically undersupply. They chronically don't build enough to service the demand out there. So I can't say that enough. And this is the reason why I have some family member from they bought 10, 15, 20 years ago, and they're all they don't speak any English, but they wind up becoming the landlord to the guy who worked at a hedge fund, the landlord who the Ivy League investment backer, right? Like they're their landlord, but they don't speak any English. They don't understand official markets. They don't understand cost of capital. So they just bought and held on. New York City, I think every city has a certain motto to how you get wealthy. Chicago is a town where you make money as a developer. You build something, you build a nice shiny office building, and you flip it. You put you get a nice roster tenant in there. You get 15-year leases in there, like how Hughes did, right? They developed this new shiny building, and they sold it for $1 billion. So like Chicago is a town where you don't want to hold on to assets in the long run because the zoning is very lax. They keep building more. New York City is a city where the money's really made on sitting around and watching paint dry. It's literally just you buy something and you just sit on it. And that's kind of the core of my strategy. My core strategy is watching paint dry. It is the most boring thing, but over time, it's hard to build. You can push through 3 to 4% rent increases. And what's unique about this specific situation is we're probably going to go through 2 years where they're going to get 10% rent increases every for 3 years in a row.
I was, as you were saying that, I was just thinking like New York City is the ultimate compounder bro market, right? You just buy it and you hold it forever, and you let the demographics and the moat do the work for you.
Yes.
Real quick, you mentioned inflation a few minutes ago, and I don't think we need to talk long about it, but I don't think I'd be crazy to say Clipper is a huge beneficiary of inflation, right? Like most of their buildings, I'm looking at their debt right now, almost all of it is locked up for the next 7 to 10 years at very low interest rates. Obviously, inflation goes crazy. If you've got the rent controlled buildings, it's going to be tough to pass through, but the non-rent controlled buildings, you're going to be able to pass that straight through. Once the building's in place, it's not like there's crazy amounts of upkeep. So big inflation beneficiary. Am I thinking about
Yeah,
that
I mean,
correctly?
I think in an inflationary environment, you definitely want to own hard assets, right? Like, you definitely want to own hard assets. And if you think about fixed costs of these, a lot of the time is it's really the mortgage payment. There is a maintenance capex component to all of this,
Of
right?
course. Yep.
But your replacement cost goes up. A good example is when I bought my first rental apartment in 2008, I paid $250 a square foot for it, right? Just to kind of replace that, right? So someone built it, sold it to me, made a profit on it. They might have built it for 180, 170, 180 a square foot, and he made $70, $80 a square foot selling it to me, right? Today to like replace that, like just to build the shell, like not even the cost of land, it's probably you know, $300 just to build the structure. And then you got to pay like 150, $200 for the land, right? And then to kind of go through the entire process. I mean, that building's, double, right? And
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 I was about to say, you benefit from a different type of inflation too. You probably benefit from regulatory and bureaucracy inflation too, right? It was a
mhm,
lot easier to build in 1995 than 2005, and it was probably a lot easier to build in 2005 than it is today, and probably doesn't get any better 10 years from now.
no, and yeah, exactly. If anything, the sites gets used up. If you look at an overhead view of New York City, right? There's just not no big empty parcels of land. The last time that we had something like that was when they built Hudson Yards, right? That was a multi-decade kind of like lobbying effort, lots of political back and forth, right? That was probably the last big parcel that got built in New York City. Other than that, like what you're really doing is you're going around the neighborhood. There's an old warehouse, you pay $40 million for an old warehouse, and then you knock it down, you maybe build 200, 300 units.
Let me
Yeah,
shift gears a little bit. We did metrics, right? We talked, hey, probably about 24 times trailing NOI,
yeah.
FFO, however you want to break it down. This is real estate. Everybody wants an NAV number. How would you break out the NAV for Clipper right now?
I think the NAV is probably somewhere in the high teens, close to 20, right?
As
And
we're talking, it's 9 NAV, high teens to 20. So it's trading for about half of NAV, obviously a
yeah,
levered number and everything,
yeah,
but
yeah.
that's kind of how you're thinking
And
of it.
and I would, I'm comfortable saying that because it's subscale, it's illiquid. There's, the management team isn't quite, kind of like REIT savvy, right? Like put a 15, 20% discount on that. Like still gets you to a $16, like what I think it should trade at, and it trades at about 9 today. Like if you got a $16 figure on it, that's over 70% upside while you're getting paid a 4% dividend to wait.
Let's talk management team.
Yeah,
That's a great transition. So I want to talk a couple things management
sure.
team. First, look, I think the management team, I haven't talked to them, but you look at their background, it's great.
Yeah.
They've got a great background, but the two things that jumped out to me, just looking through the 10K, looking through the
Mm,
proxy were, uh, I guess three things. A, the CEO's son is the COO and probably
yeah,
set to take over for the CEO, the CEO 72. And, New York real estate guys hang on as long as they can, but eventually there'll be a transition. So,
yeah,
number one, father, son in charge of a real estate property with part B. They've got a lot of equity ownership, but there are some related party transactions here. So, I start seeing, oh, New York City real estate, the son is in there, the father's in there, related party transactions. And I start to wonder, hey, am I in a heads they win, tails they don't lose situation where one way
mhm.
or another, they're kind of going to take a lot of the money. Real estate is famous for there's always a hidden fee in there. There's always a little extra kicker for the manager. Do you worry about that at all here?
So I've done, we've been in the name for 2 years, and we talked to them at Navy years before that, and I've done some, back channel check. What we get is people say, okay, like if you read the tenant reviews, like they don't really like that. But I was able to talk to a couple shareholders who've been invested for many years with them. And the feedback is, look, they're reasonable people. They're just never try to take advantage of me. And like someone mentioned, is there a take on the risk, right? And like let's think through. Like in early 2020, their equity traded below $6, right? So they own 60% of the shares. And they just did a cash out refi. They had $100 million of cash on the balance sheet. Like if they wanted to take the company under, like that was the time to do it, because they just did a big cash out refi. Like literally was probably $100 million. Like that was like exactly what the number would have been for them to just take the entire company private, right?
Yep.
What they winded up doing was that in around Thanksgiving in 2020, they did a $10 million share buyback. So like to your question, like why aren't they buying back shares? They bought back $10 million of shares at $5.70. The stock is at $9 today, right?
It's pretty nice. And you saved, not that it's huge, but you saved the dividend in the meantime too. So your total return on that buyback is actually even higher.
Yeah. So this is where, I have not found anything that, we've been shareholders for 2 years. I have not found any evidence of them doing anything that upsets me, that I think are, harmful to minority, right? And there was a golden moment to take the whole thing private because they had the cash. That was like the perfect moment to do it. And I think I think like if it was 2020, you're in a small illiquid REIT, like you might have actually woke up and be like, hey, like you give me the liquidity to get out, like like pay me a 20% premium, let me just get out, right? So that didn't happen. In terms of the but I would love for anyone who's listening to this, like if they know more than I do, I'd love to hear it. Like, please reach out to me.
I say that all the time. I'm like, look, I put a lot of stuff out on the internet. If you disagree with me and you're thoughtful, right? I get all sorts of trolls who disagree. But if you're thoughtful, I would love for you to come and be like, Andrew, you're wrong, and here's X, Y, and Z reason why. Like that's part of the reason I put stuff out there. So I'm with you. Let me ask you another question. Look, we mentioned at the front of the show, this trades for about 4.5 times cap rate on trailing numbers. If you run it forward, let's say, the NOI goes from 65 to 90 million, that'd be about a 6% cap rate, right? What is the cap rate for multifamily in New York right now?
I mean, for the really trophy stuff, like it was like a 3 handle, right? Like you're probably looking at like low 4s. And there's also a component of like dollar per square foot, right?
Yeah.
If you look at like going back to the map that I was laying out, right? Like this is 3.2 million square foot. Like if you look at the Tribeca house and Clover house, like if you want to buy that, that's $1,500 a square foot. Now, not the entire portfolio is like that, but I think at what it trades at on a dollar per square foot basis today, it's about 420. Now, the 1.7 million square foot that's rent stabilized out in Flatbush, right? That's maybe like $300-400 a square foot, right? But all the other stuff, probably averages about close to $1,000 a square foot, right? So when you blend it all, like on a dollar per square foot on a cap rate basis, like gun to my head, I would probably say that 4.5% cap rate, somewhere in the low to mid 4s is probably the right cap rate. Like if you want to be concerned, like if you want to say, okay, because they own some office, they own this rent regulated. The thing about rent regulated is that it's a very large square footage, but it's like the 80-20 rule, right? It's a very large square footage, but it's not a lot of the value. Like a lot of the value. Another way of looking at it is if you take their 2 best buildings, which is Tribeca House and Clover House, right? If you back out the equity and you add the cash on the balance sheet, like if you take Clover House, Tribeca House, and the cash they have on the balance sheet, that's your market cap. You kind of get everything else for free, right? Like that's another way of looking at it.
Great. I was going to ask a question along those lines. So that's perfect. Let me ask you, they've got 2 development properties, if I'm remembering correctly. One One is in Prospect Heights. It's a mile from Atlantic and Barclays. I think they're going to put 85 million into it. And then they just bought it's 953 Dean Street, which I don't know where in Brooklyn that is, but I think that's
right next to 1010 Pacific.
To where?
So
it's right. So they're basically developing that block.
They're like literally like one street over, and they're almost like touching each other.
So 1010 Pacific, they're going to put like 85 to 90 million in. Dean Street, I think about 50 million. So that's 140 million. You know, we just said this is a 400 million market cap company. So this is it's a big investment. So how are you looking at those developments and the value creation there?
So I've been out there, like as with all my real estate, I've been in like, I put boots on every single one of these buildings, right? Like I put boots on like I've been inside, I've looked at their apartments. I've told the doorman I was looking to rent, you know, so I've seen all these assets, and 10 Pacific is in a, you know, nice fun area in Brooklyn. My brother-in-law actually just rented an apartment last year around that area, and they're not where he lives, right? They're like like in real estate development, you generally want to be you want to see where the trends are going, and you want to kind of be a little bit on the frontier, right? And like, you know, after spending a few a few afternoons, a few nights out with my younger brother-in-law, I'm like, this is a really fun part of Brooklyn. This is a really fun part of Brooklyn. There's where they are right now. There's like a cool Brooklyn thrift store, right? There's like some warehouses which are all getting knocked down to be like developed into multifamily, and there's just you could just kind of see that it's all moving that way. It's all moving towards that way. Like on I think Fifth Avenue or Fourth Avenue, where Fourth Avenue is where my brother-in-law lives. Fifth Avenue, there's a ton of restaurants, and then it's hard to describe like without a map. But I've been to the neighborhood. It's a fun, vibrant area where a lot of young people want to live in Brooklyn.
And look, I think if I'm just doing the math in my head right, let's say they're investing 150 million into the two of these. I think they say they're going to develop them at about a 6.5% implied cap rate. If those end up being worth a 4.5% implied cap rate, I think the math says they create 80 to 90 million of equity value through that. Yes. And again, this is a $400 million stock. So if that's right, and I think you get a margin of safety in there, right? If it ends up being a 5.5 instead of 4.5, it's only 40 million. Like that's still a lot of equity value creation for the stock here.
Yeah, well, I mean, that's the thing is that you're not paying for any of that, right?
Yep.
You're not paying. You're paying for the equity value in Tribeca House, Clover, and the cash on the balance sheet, right? You're not paying for the rent regulated stuff. You're not paying for the office building. You're not paying for the Central Park building where it's actually right near the Central Park croquet court, right? Like where I used to play croquet. You're not paying for the Upper East Side, right? Like you're just getting a ton of free optionality, and I like the development project because what it does is that one of the things that people complain to me about is well, no one's gonna like assign any value to some construction in progress or land parcel, right? Like because it doesn't throw off any cash. Right? People want to be able to run a screen and say this is cheap because it trades at 10 times price to AFFO, right? Or this is cheap because the NOI, it's a 6% NOI, and that's too cheap for multifamily, right? And I think when those projects gets developed, get stabilized, now it's a bigger company. It's got more scale. You know, it looks more real to people, and people could just slap a multiple on it, right? Like that's my strategy. My strategy is I own them usually 2-3 years before the rest of the market figure out that hey, like like this was really cheap, but like the market needed to see it when these assets gets leased up and stabilized.
For Clipper, you know, I think I said it with FRPH, but the great thing about FRPH was it was one of those businesses, it was one of those stocks, it was just impossible to kill, right? No matter how we broke it down, because they had so many different sources of value and the debt was structured properly. Like, it doesn't mean you're going to make huge amounts of alpha, but you weren't going to take a zero on it, right? And 6 months ago, you and I were talking before the podcast, nobody wanted to hear about the safe assets that were going to generate nice returns. Maybe again, I'm not saying it's not going to generate great alpha, but maybe it does, maybe it doesn't, but it wasn't going to be zero. And today, you know, after we've had Peloton down 90%, we've got Zillow down 90%, like after all these things have blown up, you kind of reassess and say, oh, maybe that thing where Maybe the return's 8%, maybe it's 15, but it's definitely not going to be negative 20. It starts to sound a lot better. And Clipper, it's the same thing, right? Like all the debt is non-recourse. There's cash at the holdco. So a zero is literally off the cards unless management went and did something completely crazy and lit money on fire, right? Like you literally can't zero it because you can't go bankrupt. So
well, I mean, let me walk through that a little bit, right?
Go ahead.
Because during the financial crisis, I mean, these are lessons that I learned, right? Like, so there's like jitters. Like if you look at the REITs, right? The REITs like kind of sold off a little bit this week, right? And I guess they reversed today. The market rally, the S&P rallied 3%. And like from the moment we started talking,
I hate to base any podcast on like one day. The Fed, it's the biggest Fed meeting ever.
No, but like there's a trend of like rates going up, right? And in any sort of real estate failure, and I've seen a lot of real estate failure, right? It's usually a function of you got debt coming due during a time when it's very inopportune, right? Like it just like if you look at General Growth, right? Like why did General Growth go bankrupt, right? Like,
that's the one I was going to say, because it's the trade. I was in college at the time. I always regret it, but they had great assets. Nobody doubted the value of the assets, but all their debt came due during the financial crisis.
Exactly. They have, they did that deal that I think it was a $5 billion unsecured that came due and the capital markets was not open and they had to file for technical bankruptcy, right? Like how does this thesis get killed, right? And let's look at debt maturity. They had a $20 million construction loan that are on 1010 Pacific that I think that's due in 2027, and then the next one is 2028, which is Tribeca House, right? So really, like the really big chunk, Tribeca House, I think has over $300 million of mortgage on it, right? So really, the next big event where like you really need to worry is literally like 6 years away, right?
And even if they can't refi it, it's not recourse, right? So you lose the property, but you don't destroy the company.
Exactly, and that's a key. Like everything comes after 2028, right? So you like to really and like from an equity holder perspective, you get over 4%. So like between now and then 6 years, I mean, getting 24% of your capital back isn't like doesn't it isn't gonna like you're not getting all your money back, right? But you're getting a good chunk of your equity check back, right? And they should increase the equity between now and in 2028, right? So to physically break this company, you're looking 6 years out, and you really need that. But like they need to do something that's very, very dramatically different than the playbook that they have. And then like going back to like, okay, like the family, they own 60% of the equity, and their 60% equity, $26 million, 26 million shares times 38 cents. They're getting $10 million a year in dividends, right? Like this is what I've kind of noticed about the market is that people say, oh, like, is a governance right? Is like it's like if they did anything to kind of ruin the situation for themselves, they're literally taking $10 million, like they're paying $10 million of dividend check away from themselves. Like sometimes like whatever comp package that you put together, it's like have management team own 60%, and that kind of takes care of a lot of problems.
It's funny because I was talking for completely different subject, but Twitter, Elon Musk is he's going to buy Twitter, right? And if he walks away from it, he owes them a $1 billion break fee. And me and someone were debating, we're like, is $1 billion, is that enough to hold him to the fire for the richest man in the world? It's just, and when you were saying it's a $10 million check, I don't know their finances, but I was like, I don't know their finances. They're New York real estate finance science. I'm sure 10 million matters, but does it matter to them? But it's just funny. I have one last question for you, and then I'll let you kind of have the final words to wrap this up. Just in their conference call, I didn't investigate it. They said somebody asked, you've had elevated litigation expense for a while. They say we don't expect anything else. It was some litigation that's now settled. What was going on with the litigation?
So my understanding was that in their Tribeca house, right, there were some sort of tax, like property tax related. Let me see. Hold on a second. And that was some of the tenants sue saying they charged more rent than they should have, right? Because the Tribeca house has some sort of favorable tax treatment, right? and that's behind them. And that's, I've asked them before, hey, how big is this liability? And they're like, maybe it's like a couple $1 million, but like, it was not 10, 20, it was not $50 million, right? It relative to the size of the enterprise, it's not really material, but that's behind them now.
It's fine. I just hear somebody call it elevated litigation expense, and your mind can go all sorts of places. That's perfect. Cool.
No, well, this is not like a Bowen liability on the max, right? Like that's a different kind
of. We've been going for almost, I think, over an hour at this point. We hit all the points I wanted to hit, but I wanted to turn it over to you for the last word. Anything you think we should have hit that we didn't hit, or anything you wish we had hit it a little bit harder?
Let me see. I mean, I think the best thing, like I would suggest people, if people want to follow the thesis kind of in real time, right? Like one thing that you could do is you go to Street Easy, right? Like I love to do this sleuthing, right? You go to Street Easy, type in Tribeca House, type in Clover House, and you could like look at the units that they're showing you. And you could literally see like what the asking rent is, right? They'll tell you what the square footage, they'll tell you like what the asking rent is. And you could, like, any investor want to own this thing, you could like figure out how much the existing rents are below market, right? And you could like click on some of the units, and it will literally show you what rent was in 2019, how low they got in 2020 during COVID, and what they are right now. So that's like a great way for people to independently verify whether I'm BSing or not.
I'm going to put you on the spot, Bill.
Okay.
1-bedroom apartment, Tribeca House. How much is it going for right now?
What's the square footage? Because that matters a lot.
I don't know how big my apartment is. I was asking for a friend.
Probably $5,000. Like if gun to my head, probably $5,000 for 1 bedroom.
Nah, I'm staying in my current apartment. That's too rich for my blood. That's not podcaster.
I mean, it's $83. I think they were saying it's $83 a square foot. So if you have like a 600, right? Like that's right around that high 4,000s. And depending on the, like if you got a 1-bedroom in the penthouse, it could be more, right?
I mean, what the best IR campaign they could do?
Yeah.
Shareholder rent discounts for shareholders. That's the best IR campaign they can do.
They should just host like an investor day at the Tribeca House, and people could just like come, like literally just show people the Tribeca House and Clover House. Like you could take the ferry across, across to Dumbo, and like it's like people won't understand what they own. And so the other thing I just want to add is people should follow Jonathan Miller on Twitter. He writes, he published like on a monthly basis the best data on New York City rent and condo, and you get commentary on how tight the market is, what the trends are, and also use Street Easy. Look at the units, look at like check, and then they publish supplementals, so you could see what the existing rents are, and you can compare it. Like you could easily see 20-30% delta between what the current market is and what the tenants are currently paying. And I think a good way to understand this is Sunbelt multifamily was like the hottest trade of 2021, right? And I think that COVID, essentially what it did is that New York City recovered about a year later. I think potentially this is 2022 is the Sunbelt multifamily trade, but just it got delayed another year.
Cool. Well, this was great, Bill. Yeah. The weather's getting nice. I know Seaport. I know that's another area of interest for you. I think you and I are going to have to grab a drink at Seaport real quick. But Bill Chen, thanks so much for coming on, and looking forward to having you on again.
Yeah, thank you, Andrew. Appreciate it.
Perfect.